Bitcoin just touched $70,000 and then it immediately dropped 4% in hours. While you were sleeping, while you were at work, while you were reading headlines saying the rally was back, the market set a trap. A very specific, very mechanical, very predictable trap that happens in financial markets over and over again. It has a name. It's called sell the news. And if you bought Bitcoin yesterday after seeing those green candles, after seeing NVIDIA's blowout earnings, after watching every crypto influencer on the planet call a recovery, you need to watch this video right now, because I'm going to explain exactly what happened, why it happened, what the data is telling us right now, and the three scenarios that decide whether Bitcoin is about to drop back to 63,000 or push through 70,000 for a real breakout. This is the most important 48 hours for Bitcoin in weeks. Let's go. Let me take you back to Wednesday because you need to understand the sequence of events to understand what's happening right now. Going into Wednesday morning, Bitcoin was in rough shape. It had been below 65,000. Sentiment was at historic lows. Fear and greed at 11, which is deep in extreme fear territory. 5 weeks of consecutive ETF outflows had drained nearly $4 billion from the US Bitcoin ETF complex. BlackRock's IBIT alone had shed over $2 billion in that stretch. Short sellers were piled in. Leveraged bearish positions were crowded. The mood across crypto Twitter, across finance Reddit, across every financial news channel was, Bitcoin is broken. The bull market is over. We're heading to 60,000, maybe 55. Then Wednesday afternoon, two things happened almost simultaneously. First, the Jane Street lawsuit news was spreading virally on social media, with thousands of users claiming that the mysterious 10 a.m. daily Bitcoin dump pattern had suddenly vanished now that Jane Street was facing legal scrutiny. Bitcoin started moving. Then NVIDIA reported earnings, $71.4 billion in quarterly revenue, up nearly 80% year over year. Every single metric beat. Guidance for next quarter above Wall Street expectations, and the Nasdaq exploded higher. Risk appetite came roaring back across every tech-adjacent asset. And Bitcoin, which has been moving like a leveraged version of the Nasdaq throughout this entire cycle, followed that wave with full force. Here's what happened next. Crypto Twitter went wild. YouTube thumbnails everywhere started screaming 72,000, 75,000, the bull run is back. And retail investors, who had been sitting on the sidelines, who had been scared, who had been telling themselves they'd buy at 60,000 but never pulled the trigger. They panicked. But this time they panicked in the other direction. Instead of fear of losing money, they felt fear of missing out, and they bought. Hard. At 67,000, at 68,000, at 69,000, right as Bitcoin was racing towards $70,000. And then Bitcoin hit 70,000 and stopped and reversed. And as of right now, it has given back over 4% of that move, back below 67,000. The people who bought yesterday's close, the people who chased the NVIDIA rally, are already underwater, and most of them have no idea why. Stop. This is the moment where I need you to actually pay attention, because what I'm about to explain is the most valuable trading concept you'll hear today. It's called buy the rumor, sell the news. And it's not a crypto phenomenon. It's not a manipulation conspiracy. It's a fundamental feature of how every liquid financial market in the world works. And until you understand it in your bones, not just intellectually, but emotionally, mechanically, you will keep getting caught in this trap. Here's how it works. When a major catalyst event is coming, in this case NVIDIA earnings, informed, sophisticated market participants begin positioning in advance. Hedge funds, algorithmic traders, institutional desks, they start buying assets they believe will benefit from the event before the event happens. That buying pushes prices up in anticipation. By the time Wednesday afternoon rolled around and NVIDIA actually reported, a massive amount of that anticipated good news had already been priced into Bitcoin, the Nasdaq, and tech stocks. The price had already moved to reflect a large portion of the expected positive outcome. So when the news actually dropped, even though it was genuinely excellent news, there was less incremental buying left to do. The sophisticated players who had positioned in advance, they started selling, not because the news was bad, because they had already made their money on the anticipation, and now they were taking profits. And as they sold, price started drifting lower, and the retail buyers who had chased the move right at the peak, who had bought the actual news event rather than the rumor, they're the ones holding the bags. This is not a new phenomenon. This is not specific to Bitcoin or crypto. This happened with Apple earnings. This happened with Tesla earnings. This happened with Fed rate decisions. It happens with geopolitical events. Whenever a market has been running up into a catalyst, the catalyst itself frequently becomes the selling event. And it is one of the most consistent, most repeatable patterns in financial markets. And yet, every single time it happens, millions of retail investors get caught by it because it feels impossible to believe in the moment. When the news is good, when NVIDIA just reported 80% revenue growth, how could prices possibly go down? That disconnect between the news is good and the price is falling is what makes this pattern so psychologically difficult to navigate. Here's the trap in specific numbers. Bitcoin touched $70,000 during overnight trading on Wednesday. That's the highest it had been since before this entire correction began. Retail sentiment was at maximum excitement. Social media was flooded with "we're back" posts. And yet within hours, Bitcoin has given back 4+% of that move and is trading below 67,000. At the same time, the Nasdaq is down 2% in US morning trading Thursday. Coinbase is down 1%. Strategy, the biggest corporate Bitcoin holder, is down 2.3%. Galaxy Digital is down 3%. The entire risk-on trade that NVIDIA's earnings triggered on Wednesday is being unwound on Thursday morning, not because anything fundamentally changed, but because the news is now out, the catalyst has been priced, and the sellers have stepped in at exactly the level where the buyers ran out of ammunition, $70,000. That level matters enormously, and in about 20 seconds I'm going to walk you through exactly why 70,000 is the most important resistance level on the Bitcoin chart right now, and what needs to happen for it to break convincingly versus what happens if it doesn't. But first, let me tell you about something that is dominating conversation on crypto social media right now, because it's both fascinating and instructive, and it connects directly to what happened this week. The Jane Street theory. If you've been on crypto Twitter in the last 48 hours, you've seen it. The claim goes like this. Trading firm Jane Street, one of the world's largest and most sophisticated proprietary trading firms, has allegedly been systematically selling Bitcoin at 10 a.m. Eastern Time every single trading day since November. The theory is that Jane Street was pushing Bitcoin down at market open to buy spot ETF shares at artificially cheap prices, effectively engineering a discount for themselves at the expense of retail holders. The evidence cited? Two things. First, there was a consistent pattern of Bitcoin weakness around 10 a.m. that many traders had documented over months. Second, Jane Street was recently sued in connection with the 2022 Terra Luna collapse. And here's the data point that sent the theory viral. The day after the lawsuit was announced, Wednesday, the 10 a.m. dump pattern apparently didn't happen, and Bitcoin surged 6%. Now, here is where I want to be extremely careful, because intellectual honesty matters more than a viral narrative. Crypto economist Alex Kruger actually pulled the data on this theory, and what he found is that since January 1st, IBIT's cumulative return in the 10 a.m. to 10:30 a.m. window is actually positive, up 0.9%. And the 10 a.m. to 10:15 a.m. window is only down 1%, which is noisy, not systematic. More importantly, both windows closely mirrored Nasdaq performance, meaning the so-called 10 a.m. dump was simply part of broader risk asset repricing that happens when U.S. markets open, not a coordinated Jane Street scheme. What's actually interesting is that Jane Street is an authorized participant in the Bitcoin ETF ecosystem, meaning they have a legitimate, regulatory-defined role in creating and redeeming ETF shares. They're not a rogue actor. They're a piece of the institutional plumbing. That doesn't make them popular. But it does make the manipulation theory significantly more complicated than the viral posts suggest. Why does this matter for today's video? Because the Jane Street theory is a perfect example of how narratives move markets even when the underlying data doesn't fully support them. The belief that Jane Street's lawsuit stopped the morning dump was part of what fueled Wednesday's rally. The conspiracy theory, real or not, became a market catalyst. And now, on Thursday morning, with Bitcoin pulling back 4% despite NVIDIA's excellent earnings being out in the open, the narrative is being tested. Was Wednesday's rally about real structural change? Or was it about a short squeeze, a viral conspiracy theory, and a macro catalyst that has already been priced? That is the central question. And the answer, which the market will give us over the next 48 hours, is the most important thing to watch right now. Here's what I need you to understand about the $70,000 level. It's not arbitrary. It's not a round number that only matters because humans like round numbers. It's a structural level with real technical significance. Multiple analysts, including the team at Bitfinex, have pointed to 70,000 and 72,000 as the zone where sellers have consistently stepped in, where recent rallies have stalled and reversed. Above that zone sits what Bitfinex calls the true market mean, an on-chain valuation metric that estimates Bitcoin's fair value based on actual capital flows into the network, which currently sits around $78,000. That level, according to the analysts, must be reclaimed on a sustained weekly basis before the structural picture actually improves. Not touched intraday, not briefly crossed, sustained, on a weekly close basis. That's a very high bar from where we sit right now at 67,000. Also consider this. ETF holders are currently sitting on significant unrealized losses. When you have a large population of buyers who are underwater, who bought Bitcoin through ETFs at higher prices and are now in the red, every rally toward their entry price becomes a selling opportunity. Not because they're bearish long-term, but because they're running risk budgets, they have performance mandates, and getting back to break-even is a powerful psychological and institutional incentive to reduce exposure. That dynamic creates what traders call overhead supply, a ceiling of potential sellers at every price level above current trading that keeps putting a lid on rallies. And that overhead supply doesn't clear until Bitcoin sustains prices high enough, long enough, that those underwater holders either exit at a loss or decide to hold through to new highs. Now let's get into the three scenarios because this is the framework you need to carry into the next 48 hours. Scenario 1, Bitcoin holds 66 to 67,000 as support and makes a second, stronger attempt at 70,000. This is the bull case. For this to work, we need to see the Nasdaq stabilize and recover from Thursday's 2% drop. We need to see ETF flow data stay positive. Wednesday's $506 million inflow day needs to be the beginning of a trend, not a one-day event. And we need to see Bitcoin build a base above 66,000, which, remember, is approximately its average production cost, before making another run at the resistance zone. A second attempt at 70,000 with more volume, more momentum, and a more constructive macro environment would have a much higher probability of breaking through than a solo squeeze-driven push. If it breaks and sustains above 72,000, the technical picture shifts dramatically, and 78,000 becomes the next real target. Scenario 2, Bitcoin consolidates in the 65 to 68,000 range for several days. This is actually a healthy outcome. After two back-to-back days of large moves, Wednesday's 6% surge and Thursday's 4% pullback, the market needs to digest. Price oscillating in a relatively tight range above key support would allow the stochastic RSI to cool from its overbought reading, allow ETF flows to build a more sustained pattern, and allow macro sentiment to stabilize after the NVIDIA sell the news event. Consolidation above 66,000 is not bearish. It's the setup for a real move. If you see Bitcoin chop between 65 and 68 for 3 to 5 days on declining volume, that's not the end of the rally. That's the rally reloading. Scenario 3, Bitcoin loses 65,000 with volume and momentum. This is the scenario where Thursday's reversal was not a healthy pullback, but a genuine signal that the Wednesday move was a bear market bounce. A relief rally inside a larger downtrend that has now exhausted itself. If this plays out, the data that matters is the $60,000 level. Multiple analysts have been very specific about this. A break of 60,000 with conviction opens the path toward the mid to low 50,000 range. The ETF complex has already lost over $4 billion in outflows year to date. 62% of ETF inflows are currently underwater. If macro conditions deteriorate further, if the NVIDIA sell the news event spreads to a broader Nasdaq correction, if tariff escalation headlines return, if the Nasdaq breaks its recent support, Bitcoin has no structural floor between 60,000 and the 50s. Have a plan for this scenario before it happens. Here is what nobody is talking about that I think is the most underrated dynamic in the entire current Bitcoin setup. We talked last video about the hash ribbon and miner capitulation. We talked about the Coinbase premium turning positive. We talked about on-chain demand returning. All of those signals are still intact. The sell the news event on Thursday did not break those structural signals. The Coinbase premium hasn't collapsed. ETF inflows on Wednesday were real. Miner hash rate is still recovering. Those are slow-moving structural signals that don't reverse on a single 4% daily candle. But, and this is the critical distinction, structural signals tell you the direction of the thesis. They don't tell you the speed or the path. And right now, the path from structural bottom signals to a sustained price recovery is being complicated by two things: the overhead supply problem from underwater ETF holders, and the macro correlation with a Nasdaq that just experienced a sell the news event on its biggest earnings catalyst of the quarter. None of this is financial advice. I need to say that clearly. Nothing in this video is a recommendation to buy, sell, or hold any asset. Crypto is extraordinarily volatile. A 4% move in a single day is not unusual. It is Tuesday for Bitcoin. If you are trading this asset with leverage, the volatility you witnessed in the last 24 hours, from 70,000 down to 67,000 in hours, and that is exactly the type of move that liquidates leveraged positions without warning. Size your risk appropriately. Know your stop-loss levels before you enter, not after price is already moving against you. And never risk money you cannot afford to lose entirely. Here's what I want you to walk away with from this video. The $70,000 level is not the enemy of Bitcoin bulls, it's a test. Markets test key levels. They probe resistance. They reject. They consolidate. They try again. The first touch of a major resistance level almost never produces a clean breakout. There's almost always a rejection, a pullback, and a second or third attempt. What you just witnessed, Bitcoin touching 70,000 and pulling back 4%, is entirely normal market behavior at a key technical level. The question is not whether Bitcoin was right to pull back from 70,000. Of course it was. That's what markets do at resistance. The question is whether the pullback finds support at a level that sets up a higher quality second attempt, and the specific levels to watch for that are 66,000 in the production cost floor and 65,000, the next major technical support below that. Watch those levels. Watch the Nasdaq, because until Bitcoin proves it can decouple, macro drives institutional flows and institutional flows drive price. Watch daily ETF data tonight. If Wednesday's $506 million inflow is followed by outflows on Thursday, that's a bearish signal for the second attempt thesis. If ETF flows stay positive, even with Thursday's pullback, that's a bullish signal that institutional demand is structural and not just a one-day reaction to NVIDIA. And watch the Jane Street story, not because the conspiracy theory is necessarily true, but because narratives move markets, and if that story continues spreading, it affects sentiment in ways that become self-fulfilling. Drop a comment below right now. I want to know, did you buy the Wednesday pump? Are you holding? Or did you sell Thursday's dip? The real-time sentiment in the comments here is one of the most honest reads I have on where US retail positioning actually is. And I genuinely read every single one. If this breakdown helped you understand why markets do what they do, not just what they're doing, but why, hit subscribe. I put these out every single time a setup like this develops, which apparently right now is every 24 hours. You don't want to be the last one to understand what's happening while it's happening. See you in the next one.